Hi, Reed Fraasa with Highland. Thank you for joining us on this video series. You can click the link below to subscribe to this at any time. We hope that this video series helps you, the consumer, learn more about the financial services world, how it works. This is one of the most important decisions you may make in your life. You can choose to do this on your own, but if you decide to work with a financial advisor, there's going to be a cost associated to that, and you want to make sure that you're making the right decision. And that's what I'm going to talk to you about today. All the costs that you need to be aware of when you decide to work with a financial advisor, and some of these costs are relative to you working on your own. Now, my previous video talked about questions you should ask about how the financial advisor is unique, what services they provide, what is their purpose. I suggest you go back and watch that if you haven't. But today I'm going to talk about three things around cost. First, I love this quote from Warren Buffett. Cost is what you pay, value is what you receive. So in any kind of transaction, you always need to evaluate cost and value, cost and benefit. When I plan a vacation, the first thing I do when I'm looking at hotels, I go straight to the booking page and I see what it's going to cost me for the room. Because if it's outside my budget, I don't care what the amenities are or the location, I'm not going to book it. So cost is always in the back of our mind. I know when a new prospective client comes into our office and we start talking to them about what relationship they're looking to have, I know in the back of their mind they're always thinking, what's the cost, what's the cost, what's the cost for this? If you look at our website, highlandplanning.com, you'll see on the very top of the homepage, the very first thing you see is a full transparent disclosure of our fees. We don't want people going through our website getting all excited and then they realize that there's a cost for this. So it should be very transparent. I challenge you to go to other advisors' websites and find such clear, transparent disclosure of their fees. So there's three types of costs that you could incur. First one is the cost for transactions. What potential costs could you incur as a consumer if you buy or sell things? The second cost is the internal cost of a product. Is there a commission? What is the expense ratio on a fund? This is the product-related cost. The third cost is, are you paying an advisor fees? Or is it hourly? Is it project-based? Is it based on assets? What is that cost? And what is the reasonable cost for something like this? The first one is, what are the transaction costs? When it comes to securities, you can't buy or sell a security. That would be a stock, a bond, a mutual fund, or an ETF. You can't buy or sell that without incurring a transaction cost. And that has to be done through a broker-dealer. Now, a broker-dealer could be a Wall Street firm, could be an independent broker-dealer, could be an insurance-based company. If I want to sell something and you want to buy something, the broker-dealer is going to facilitate those trades, match up our orders. That's called a broker trade. If they have their own, say, municipal bonds that they're holding in their portfolio at the company, and I want to buy one of those and they sell that bond to me, they're acting as a dealer. And that's where the term came from, broker-dealer. Typically, in most broker-dealers today, if you buy or sell a stock, bond, or ETF, there's no transaction fee to you directly. A mutual fund could be no transaction fee, or there could be a cost for it. But typically the costs are not more than, say, $10, $20, $30, or $40 to buy or sell something. And you're not buying or selling a lot. The second area of cost that you should be aware of is the internal cost of the product you're buying. So if you buy a mutual fund or an ETF, these are two different types of mutual fund investment companies, there is going to be what's called an expense ratio. That's the operating cost for these investment managers to be able to pay their salaries, pay their building, the rent, and everything else to operate. ETFs are typically less expensive than mutual funds. But there's other products out there that you may own or may be pitched to you, like annuities, life insurance. They can have much higher costs. You have to understand, what am I getting for that cost? You may be paying for a feature or a service on that product that you don't need and you didn't even know why you were paying for it. So it's really important to understand all the costs, you got to ask questions and make sure you understand what those costs are related to the products that you're buying. So if you're looking at the total cost of, say, an investment portfolio, you really want to understand what is the average total weighted cost of all the positions you have and what their associated costs are. What are you paying for that portfolio, which is probably a mix of different things. You should make sure that you understand what that is and how it relates to the industry. The third costs are the advisor's fees. What are you paying the advisor? How do you know if that's a good price for the value you're receiving? If you're receiving investment management and financial planning, typically people will package that as wealth management under an ongoing fee based on the assets that they're advising on. And this is where a lot of people get confused because they don't understand how much of that fee is for picking and managing their investment portfolio and how much of that fee is for the financial planning advice. And that's a great question to ask to understand that. You should ask an advisor, how much of this fee goes for this investment picking and how much of this fee goes to you providing ongoing advice, monitoring financial planning. We know from our experience that about 75% of our fee is for the financial planning, advice, and ongoing monitoring. And only about 25% of our fee goes towards ongoing investment management costs. So if you look at that and you look at the industry, the average cost out there with independent investment advisors is about 1% up to 1 million, sometimes 2 million. So that 1%, how did that come about? Where did 1% come from? Well, most people think that it originally came from the mutual fund industry. Back in the 60s and 70s, the mutual fund industry primarily had three types of share class to buy a mutual fund. One was A shares, and A shares is where you pay a upfront commission to buy shares in a mutual fund, and then the more you put with that company, you would get break points. The second was B shares, B as in boy. That was where the companies, mutual fund companies, needed to start competing with the low-cost index no-load providers. And in order to do that, they came up with the idea of a B share where you put your money into the investment, you paid no upfront cost. So 100% of your money got invested. And as long as you held it for at least 5 years, you didn't pay a charge if you left. But if you sold it within the first 5 years, there was typically a declining sales charge. They had a third class, which were C shares. C shares was where there was no back-end charge and no front-end charge. Instead, the mutual fund company charged a 1% fee. Now, the person thought they were getting something with no front-end cost and no back-end cost, but there was an ongoing cost to this. And that 1% that the mutual fund companies came up with, when brokers started to leave their employers and form their independent companies, that really translated to become the fee that everyone started charging. Did they pull it out of a hat? No, but not far from it, because again, what's the value, the services they're providing for that? In our opinion, if all you're receiving is investment selection, picking investments for you, 1%, you're probably overpaying in today's market. So if someone has a proactive financial planning service, you will realize the value of paying that 1% and them managing your investments. If they're not, and they're only providing investment picking for you and perhaps reporting on that, if you're paying much more than 1/4%, I think you're overpaying. So in any relationship with a financial advisor, you need to evaluate, what am I receiving for that fee? And what I've just been talking about is the most common fee structure for an independent advisor, which is an ongoing fee. Now, you could also pay that at a broker-dealer because they can be duly registered. They could have a registered investment advisory operation and a brokerage operation. They may have you in some accounts where you're paying a fee and other accounts where you pay a commission. Now, you may be told that by having some fee-based accounts and some commission-based accounts, that they're diversifying you, but that's not what they're doing. They're actually diversifying the revenue sources for the broker-dealer. There is no diversification concept on paying fees of one kind or fees of another. When we talk to people about diversification, it's a very different concept. It's about diversifying for risk, not about sources of income for the company. So typically the asset-based fee is the most common form, but you may also find a financial advisor, financial planner, who's willing to work with you on an hourly basis. And I suggest that if you have a pretty simple situation or you're just starting out, you're going to be better off paying someone by the hour for a few hours a year to help you make better decisions, to get you started. Later on, you might transition to something else, but it might be in your best interest to just pay someone for a few hours. Other planners will have a project-based fee. So they'll charge you a fee for, say, delivering a financial plan start to finish, or they may charge you an annual fee where we will provide financial planning advice to you with no investment management for the year at this cost based on a quarterly payment. So there's any different number of ways, and you need to ask the questions. In what ways do you charge fees? How do you offer services? What are my options? There's things that we do, I know, that add value, helping people with decisions on their estate documents, helping people with decisions on insurance products, helping people with tax planning decisions around their portfolio, rebalancing, tax loss harvesting, all the different things that we do for a client ongoing basis year after year, we believe adds value above and beyond our fees. I can tell you this, that for most relationships, the fee that you're going to pay an advisor over the life of the relationship is not the thing that's going to keep you from reaching your goals. More often than not, it's your behavior, your decision-making around things that can be most costly, assuming you have a good advisor who puts your interests ahead of themselves. Well, that wraps it up. I really thank you for watching. If you'd like to schedule a call with one of our advisors, please click the link below or go to our website at highlandplanning.com, and you'll have an opportunity there through a Calendly link to block out a 15-minute phone call with one of our advisors. And we do offer a free initial consultation to anyone whom we feel that we may be a good fit for. So please don't hesitate to reach out to us. We want to make sure that everybody understands the decision they're making and that we can help you to get with an advisor that would put your interest first. Have a great day. Thank you.